Hey, welcome to another edition of Strong Valley's Monthly Market Matters. Here's the October 22 edition, and it's been quite a reversal, thankfully, from September. So far in October, last trading day right now, but the Dow's up 12.5%. It's actually the best month on record since 1976. So, like I said, big difference from September. The S&P 500, probably a more accurate measure of the overall market. It's up about 7. The NASDAQ up about 3.5-ish. The MSCI World, so taking all of the world into account, is up about 6.5 for the month. And then bonds still dragging with inflation, and rising rates driving bond prices down. The U.S. aggregate for bonds is down about 1%. Chris, what are some of the key factors that caused the market to rally here in October?
Yeah, good morning. So a few things. Really, earnings have still been really positive. So I think the number is somewhere around 75% reporting companies have beaten their earnings estimates. So that helps, just fundamentally helps stocks do better. There seems to be this, thought that the Fed is going to slow down on raising the interest rates. We talked about this before. There's no real evidence of them indicating that they're going to slow it down. So we still expect even later this week a pretty good jump in somewhere around 75 basis points is what the expectations are for a Fed raise, and then really a couple more in going into the first part of next year. So year over year inflation at 8.2 is down a little bit from where it peaked in June. I think it was at 9.1 in June and 8.5% in July. So we're at 8.2, and we'll get into this a little bit later. But just reading reports this morning from J.P. Morgan that their thought is that it's going to come down considerably over the next few months. And the consumer still seems to be pretty strong. Sentiment picked up in August. Reported at the end of September, and so those few things, and then which we don't talk about very often, but just relief rallies. Sometimes things just get technically oversold, and especially on the institutional side, buyers come in and pick up what they think are bargains. So a lot of things happen, and the market's not just down to one factor, but it was a great October, and we're filming on Halloween, but we think we're going to end up with a great month this month. It's nice to have a little bounce back.
Yeah, it's like we always talk about. There'll always be sellers, but there won't always be buyers. And September was kind of a case of that. A lot of sellers, not a lot of buyers, and so drives the market down. Maybe a little bit more than it should have. And then except people coming in October and picking up some deals. Like I said, the expectations of a Fed pivot though are interesting because it seems like more of a hope strategy, which isn't always a great strategy.
Yeah.
But we'll see how it plays out. The meeting is here November 1st and 2nd. So what are we looking for in November? Let's just start with that Fed meeting. That's the biggest thing driving the markets right now: inflation, and then interest rates and expectations of interest rates. Like Chris mentioned, expecting 75 basis points. It's like an 88% chance based on the futures market. And then we talked about the rumors of the Fed, beginning to slow rate hikes, but probably it's not priced into the futures market. Got a 57% chance of another 50 basis points in December of 22, and then almost a 98% chance of either 25 or 50 basis points in February of 23. So probably getting to a terminal rate of 450 to 475, until 2024.
Which is where they've been guiding sort of all along being over the last 3 or 4 months.
Yeah, for sure. If you want to pull up that first chart, figure 1, you can see the difference this time between previous rate cycles is the Fed's moving at a much faster rate. The current cycle is there in the kind of light yellowish. That's almost a straight up curve compared to 94, 99, 2004, 2015. And you can see where the Fed has forecast rates to be, as time moves on. They're just doing it incredibly fast, and that's been a drag on the market.
Mm-hmm. Shock, I would say probably more than anything. And
Yeah,
and again, going back to what you said before, bonds were down again in October, another month of down performance, and so I think we're going to talk about it later about sort of the upside to having higher rates if you're a cash or you're coming into this market and want to look at purchasing fixed income or investing in a fixed income. But for those who've been holding all along, it's been a really tough drag this year.
yeah, and so November inflation readings are always a month behind. So the October inflation reading is expected to be about 8%. So that would be another downtick from June, July, and August. That's maybe helping the market right now. And like Chris mentioned earlier, that we're seeing inflation expectations right now are supposed to be back about 3% in June of 2023. So still slightly above historical averages or where they want to be, but 3% is a much more doable number than 8%. So quite a big difference there.
Yeah, and that's a headline CPI number. So sort of everything combined together, not necessarily food pricing, not necessarily energy pricing, but sort of that big CPI basket that the Federal Reserve uses to guide.
Yeah. So some other things that we're looking forward to in November, housing market. So the Case-Shiller Home Price Index peaked in June. It's been the first consecutive 2-month decline since March of 2011. We know that this is going to happen. Whenever you raise rates dramatically, mortgage rates go up dramatically, and therefore, you'll get less demand for houses. And like we mentioned earlier, there'll always be sellers. Some people always have to sell. There just won't always be buyers, and that's what drives prices down. How about internationally?
Yeah, as far as Europe goes, central bank, European Central Bank and Bank of England both expected to raise rates another 75 basis points, similar to what we're doing here. And maybe you can talk to the China issue a little bit. What's going on over there?
Yeah, so it's a global inflation is a global issue right now. Europe and England in particular actually have higher inflation than we do right now, and most of the world is experiencing pretty high inflation numbers. But yeah, China's very interesting. So it looks like President Yi is going to get another I think 5 years is their term. But he's increasingly showing a more nationalistic approach that's probably going to hurt global economic growth because China is such a big economic power. Right now, Chinese stocks, I want to say, are down about 16% for the month and 35% since July 1st. And it's not so much that you are not invested in China. It's the contribution that they provide to the global economy. So if they become more to themselves and more nationalistic, it'll definitely hurt global economic growth.
And you were talking about inflation over in Europe. So we're running in the low 8s. They're running above 10 right now, just for some reference, and expected to probably peak in the next couple of months, which is again why they're raising rates and trying to stave off inflation too.
Yeah, and then currency. So a couple areas you actually could have made money this year. Investing in the dollar. Who would have thought? Investing in the dollar has been, the dollar's at all-time highs or very close, but may have reached its peak. You got other banks around the world are now raising their rates. So as I said, the dollar is at an all-time high, but it may be coming down, and you may see a boost in international equities because of that.
Yeah. So a strong dollar typically helps us in the United States when we're acquiring goods and services from overseas, but it makes our products that we export really, really expensive. And so there's always, Adam, you talk about it all the time, there's trade-offs, right? So the trade-off is if you're a global seller and you're trying to sell, whether it's fruits and vegetables or or metal, whatever it happens to be, if you're exporting that, your U.S. made goods are really expensive relative to others. So it hurts. Sometimes that hurts sales for our exporting clients. So.
And then the last thing we're looking forward to in November, and you'd have to be, not watching TV or just completely tuned out to everything. Midterm elections are coming up. You probably see nonstop negative ads on TV like we do. But But there are obviously some important implications for midterm elections. And just to give you an update on projections, so real clear politics is a pretty good proxy for what may or may not happen. And you got the economy and COVID policy probably driving a lot of voters' decisions. And right now, the Senate projection is 53-47 Republican, which would shift that back, shift it back in Republican hands. I think that one is less debatable. I think that's pretty expected at this point. The House is the one that's kind of swung as of late. Right now, it's 222 to 212 with Democrat control. 218 is the majority. And current projections are 174 Democrat, 228 Republican with 33 toss-ups. But what you're really looking at is the pickup range. And right now, the Republican pickup range is in the range of 15 to 48 seats. So there's a pretty good probability. Again, anything can happen on election day, turnout, everything else. But there's a pretty good probability that we're going to have a Republican-controlled House and Senate, and of course with the Democratic president. Not always a bad thing. You get a little more gridlock that way, but a little bit less. What would you say? Policy change. And the market doesn't like surprises. It's a big thing we always talk about. The market doesn't like big surprises. So when you get things that are a little bit more stable, it can be a boost for the market and the economy.
And the reason, so gridlock meaning a lot of the rules don't change. And so everybody starts playing the game differently when the rules do change. And that's when you see, the markets change dramatically too. And if you get all one side or all the other, and you sort of get green lighted to make a lot of rules changes, that brings a lot of questions into how people invest and how companies grow and how companies invest their own resources. So those big changes like that, where everybody's on one side of the aisle or the other, cause problems for the market, believe it or not. I was just looking at that Real Clear Politics page also, and they're expecting an extra or three more states to turn to Republican governors also. So there seems to be this little bit of a red wave. We'll see what actually happens on what's next Tuesday, right?
Next Tuesday. Yep.
Yeah, next Tuesday it's coming. So
it'll be quick. Another thing we've been getting, just a lot of questions on I-bonds still. I just wanted to mention that we did a whole segment in that in our previous quarter roundtable. We have a link to that. If you want to, you can just go directly to that link. And I think even the link has the starting time, which is I think it's 20 minutes in. About 20 minutes in, we start talking about I-bonds. So the thing with I-bonds, we'll just recap real quick. You always hear the good things. It's that it's the pros and the cons, and often you hear about the pros from a friend or a news source, but there's some pretty significant cons for our clients. Mostly the contribution limits, which is even if you do it electronically, you can only do $10,000, and the fact that the rates adjust. So you're not going to lock in a 10% rate with a significant amount of money for any real period of time, because they're adjusting. I think they're adjusting every 6 months to current inflation rates. So again, once people typically hear all the detail, they're not as exciting as a general investment.
Well, and even if you do want to buy one, it made national news this week because there's a cutoff date coming, which I believe is today, and their website was not up. It was crashing from massive demand of a lot of people wanting to buy $10,000 or less in I-bonds. So if you tried to get on there, set up an account, you were locked out most of this past weekend.
So surprising,
and most of the time actually since about last Tuesday. So
okay, so maybe the I-bonds thing is it? But hey, at least it's there, and you can know what's going on.
Yeah, and if you're listening to this or watching this and you don't have the link, just call the office here. We all have it. We can all email it to you. You can listen to it
for sure. So the one topic we wanted to just talk about real quick is everything's been negative outside of October, But Chris, talk a little bit about maybe the silver lining on rising rates, as much as it hurts your current bond portfolios right now, and in the market, and some obviously the other areas we felt. But what are the good sides there?
Well, a couple things. If you have cash, it's really wise to make sure that you're looking at how you have that cash invested, because everybody sort of agrees that you're not going to be able to keep up with inflation when you're looking at money market rates, or you're looking at sweep rates, or even short-term CD or treasury bond rates. But 3%, 4%, 4.5%, those are all much better numbers than 0.2% or 0.1% or nothing. And so you want to make sure that your cash is working as hard as it possibly can, if you've decided that part of your money is going to sit in cash. So, and this applies to cash that you have now, plus also, if you're running a managed bond portfolio, what your reinvestment rates are, for cash flow that's coming off the portfolio also. So Schwab Money Market, which is what we would typically use, it's something that we have to manually put to work here. It's not something that just automatically gets done. So we will manually sweep most of the strategic cash that we have now is going into a money market that's paying above 3%. And I had this discussion over the weekend with a client, but we expect that to go even higher as the Fed continues to raise rates, as we discussed earlier. So go ahead, Adam.
I was going to say, I guess we should just real quick on money market. So what is money market? It's probably a half step in risk if you're looking at a 0 to 100 scale above cash. It's basically 1 to 30 day paper. So you're making extremely short term, or the money market fund itself is making extremely short term investments. And the biggest thing about money market compared to any other type of investment is the principal value does not fluctuate. It's designed to stay at $1 per share. So if you put in $50,000, you get 50,000 shares of the money market. So people typically think of it as, you put $50,000 in, you have 50,000 in money market. Well, technically, you have 50,000 shares of the money market, which is designed to stay at dollar for dollar, and pretty much always does. And that's where you pick up that extra yield over, say, a bank deposit or your credit union, where you truly are invested in the bank. This is extremely short duration paper, and that's where you get paid for.
Yeah, I mean, money markets can buy paper or investments in there that go as far as a year. Most are extremely short, and it's one of the reasons that rates have risen on money markets so quickly. Because I don't know what it is right now for the Schwab money market, but it's probably averages somewhere around 35 or 40 days in terms of what the maturities are that are in there for an average. But consequently, as interest rates go up, they continue to buy shorter term instruments in there, and it brings the rates up really quickly. So highest, did you mention this already? Highest since January of 2011?
No. Highest since
are.
January of 2011 for money market rates. Go ahead and put that chart back up. So this shows the Fed funds rate as it primarily impacts the short end. So we're talking about fixed income right now and yield. Well, in a normal yield curve, you typically get more yield as you move out on the curve. Well, the short duration right now is basically the same as the long, and that's a function of inflation and inflation expectations. So, if you look at that chart right there in December of 21, you're looking at 152, and then now we're at 383 on the 10-year. And go back to the 2-year, you're looking at 73 basis points, and we're at 422. So there's actually the ability to find some yield on the short end of the curve, which is better because it's less risk. The less duration you take, the less risk in your fixed income portfolio. Mm-hmm. So there is some some positive to rising rates, because for the better part of 10 years, the fixed income part of your portfolio, well, it's designed to reduce risk and provide a balance. It's just been a drag. I mean, if you can't earn any interest on your fixed income, it by definition, right there, it drags your portfolio return down. So going forward, this may be, this could be a better thing over the long run. Obviously, in the short run, it hasn't been good because it's driven bond prices down. But in the long run, could be a better thing for portfolios.
Yeah, and the two-year Treasury is as quickly as things are moving. 2-year Treasury is above 4.5 now. Getting close to 4.6. So I think it showed 4.3 in that last chart we looked at. So things have moved pretty quickly. And again, as the Fed continues to raise, we expect we'll have inverted yield curve it's pretty flat right now, but it's going to be technically inverted, I think, for some time, because again, raising short-term interest rates should slow inflation. Long-term bonds are typically priced on inflation, so we get these higher short-term interest rates, and because inflation is expected to go down, the longer end of the curve, the 20, 30-year bonds actually should be at a lower rate of return than the short-term ones will.
Yeah, for sure. And if you want to put up that last chart, to beware the lure of holding cash. Again, there is some silver lining to increase rates, but at the same time, don't want to fall in love with just holding cash and making a couple percent, because short-term rates are very very dependent and predictive on inflation. So implied inflation here and the 1-year Treasury yield, you can see typically move pretty lockstep. You had some dislocations there at certain points, but right now, like we talked about earlier, you get higher inflation, you get a higher short-term yield. So good to pick up interest on your cash. Not so good to go all cash.
And it's rough on the flip side of this, when interest rates start to decline and you're in a lot of short-term instruments. Where we have people that are pleased to be investing at getting 2-year Treasuries at 4.5%. When the cycle starts back down, you're coming out of 4.5% bonds and going into 3.5, and out of 3.5 and then into 2.5, and it goes the other way, and that's not the most fun, but it's part of the whole package. So
yeah, and we expect, the cycles take a while, so we're looking probably through next year, give or take, but by 2024, might see rates moving back down the other direction. Obviously, no crystal ball, but things that are priced into futures markets and what we're looking at all the time. So
yeah, that Morgan report really quickly too, looking as far out as these are their projections, obviously, but they think year-over-year inflation this time next year is at 3.0 to 3.1, and we're talking about 8s right now. So if that's the case, it's likely that the Fed is way done in raising rates, and we're going to see probably rates come back down a little bit.
Yep. So what do we got upcoming from Strong Valley? Our November topic is living a legacy, making a difference now. So you'll see some articles and posts around that. And this follows along with our Investing That Matters theme for the quarter. We try to do different themes, try to get you different pieces of material, different insights. So we're covering all bases throughout a calendar year. And hopefully content that's relevant to you and that that you're interested in. Biggest thing, we got our mid-quarter roundtable coming up in November. I think there'll be lots to discuss there. We'll get Kyle and Jason on. We'll have all 4 of us and sit around and talk about some of the things that happened over the last quarter and what we're looking forward to rest of the year and into 23.
That sounds great. I'm looking forward to the roundtable coming up. It's always great when all 4 of us are on. So hopefully we can all be sitting in the same room pretty soon.
Yeah, for sure. Well, we'll cut it there. We want to thank everybody for joining us. Appreciate the time. Hopefully you found some relevant info, and we'll see you in the mid-quarter roundtable.